Okay, we're coming along. Hope everybody's having a nice day and a good evening. It's 7 o'clock, so we'll just give it another few minutes as people continue to sign up. Seven oh one. We're just going to go to about 3 minutes after 7. We'll get started. Okay. Okay, Sean, so I think we can start in now.
Okay.
And good evening, everybody. Thank you for taking the time out of your busy lives to join us this evening. For those of you who don't know me, I know a handful of you and a couple I don't know out there. My name is Lauren Searle. I've been an investment advisor for over 26 years. And from the beginning of my career, my team and I have always relied on process planning and exceptional resources to help my clients. Our presentation this evening is the first of a three-part series designed to accomplish two main goals. Our first goal of the series is to educate our audience, that's you, on how a professional corporation can be utilized to provide significant added value to your wealth. The second goal, which is a little bit of a selfish one, is to introduce the audience to some of the fantastic expertise that my practice has available at the disposal of my valued clients. So you're going to get a great dose of education this evening, but the magic happens when the education can be integrated into your personal situation. Tonight's topic is the ins and outs of your professional corporation, and our special guest is my associate, Sean Su. Sean is our tax and estate planning team's senior tax specialist, and he's an enormous asset to my practice. I've seen him in action many times, and he's always been incredibly professional and incredibly productive for my clients. So, Sean, perhaps you can tell us a little bit about your background before we start? Oh.
Sure. So good evening, everybody. I'm happy to be here tonight. So As Lauren mentioned, I am our Richardson Wealth's tax and estate planning team's senior tax specialist. So in my role, I collaborate with Lauren and other investment advisors and their valued clients to develop wealth planning strategies and solutions, and addressing their unique needs. And um, I'm here to talk about today's topic because I come from a tax accounting background. So before joining Richardson, I spent many years in one of the large accounting firms practicing private client taxation. So I'm well aware of uh, the complexities and really the benefits that come with professional incorporation. So if we go to the next slide, Lauren. Um, so as Lauren mentioned, today is the first part of a three-part webinar. And we're kicking off with what's probably the most technical content in this series. But it's important that we start here because the concepts that we talk about today establish the foundation for the remaining topics in this series, and hopefully you'll be available to join those future sessions. But our goal today is to cut through some of this complexity, and hopefully you'll have a better appreciation for how your professional corporation can allow you to yield significant financial benefits through tax planning. So our agenda today is I'm going to start off briefly talking about the benefits of incorporation. And then we're really going to spend the bulk of today talking about how taxation works once you have become incorporated. So integrating both personal and corporate taxation, and highlighting the two main tax benefits that professional incorporation provides, which is tax deferral and tax savings. I'll have some concluding comments, and then we'll open the floor to questions. Okay, so if we go to the next slide, we'll start off talking about incorporation. So in order to benefit from incorporation, you need to be in a profession that is allowed to incorporate. So not all professions can incorporate. And the question becomes, as a professional, can I incorporate? So if you're a member of a profession whose services are regulated by a governing provincial body, it's that body that determines whether its members can incorporate. So it varies province to province, but here in Ontario, the most common examples of professions that have permitted incorporation by its members include medical doctors, dentists, accountants, and lawyers. And more recently, just about 2 years ago, realtors have become are now able to incorporate. So if you are part of a profession where incorporation is allowed, you do have to be mindful that there may be other limitations that need to be followed, depending on the applicable professional regulatory body and the legislation at play. So as one example, except for certain professions like medical doctors, dentists, and realtors, here in Ontario, our legislation actually disallows professionals from adding family members as shareholders of a professional corporation, unless those family members are also members of the same profession. And I'll speak to why it made sense in the past to add family members as shareholders later. But just note that in some professions, this may not even be an option that's available. So it's really important for you to review the applicable legislation and regulatory body that you're in to determine what limits you have when incorporating. Now, if you are able to incorporate, there are several reasons why you want to incorporate. So, and you've probably heard this in your discussions with your advisors. So some of the benefits you may have heard about include some degree of limited liability, but of course you're not able to avoid any professional liability. Incorporation also potentially simplifies the transfer of your practice during your lifetime or at death. But oftentimes the benefit that's most emphasized is financial in nature. And specifically, it's the ability to achieve tax deferral and even some tax savings by earning income from your practice in a corporation. So um, from a financial perspective, for incorporation to make sense, I think there are three main questions that you want to look at and answer. So do you have more? Do you earn more than what you need to cover your lifestyle needs? Do you want to save more and save faster? And do you want the ability to control how much personal tax you pay? If your answer to all three questions is yes, then incorporation becomes a compelling strategy to pursue.
And I just make note that with incorporating, there are some disadvantages that you will certainly have to consider, and it depends really on what the savings are for your particular situation. Because setting up a corporation is not a simple letter to the government or a simple accounting entry. It does take time, and you're going to have to pay an accountant to file on your behalf. So you just want to make sure that the benefits far outweigh the costs when you're looking at incorporating.
Yeah. So that segues nicely into talking about the benefits that you can achieve from incorporating your practice. So no, no, go ahead. Let's jump 2 slides. So we're going to focus on taxation now, and understanding how tax works is important. You're not expected to be a tax expert, but having a general understanding of how tax works is important because it's a significant cost to building, preserving, and transferring wealth. So knowing generally how tax works allows us to plan for opportunities to reduce that cost and that burden. Now, unfortunately, our federal government has not made it easy for us to do this. And as you can see on this timeline of tax policy changes over the past number of years, our federal government continues to reduce and eliminate tax benefits and savings opportunities for high income earners. And many of these changes have been on the basis that in the government's eyes, these high income earners aren't paying their fair share and should pay a little more. So I'm going to cover some of the items that are highlighted on this timeline because they do specifically target incorporated professionals. Now, on the bright side, if we go to the next slide.
Yeah, sorry, just someone was trying to get in, and I just started letting them in now. Okay, thank you.
No problem. Yep. So on the bright side, the most recent federal budget didn't propose any changes to personal income tax rates, corporate income tax rates, and the capital gains inclusion rate of 50%. So you'll see this in a bit, but the fact that personal and corporate tax rates haven't changed means that the tax advantages to incorporating continue to exist for professionals. So let's dive into this. So when you incorporate, you are obviously creating a corporation, and a corporation is a separate legal and taxable entity. So that means once you incorporate, you now have two taxpayers to deal with, yourself and your corporation. What this also means is that now you have two layers of tax to manage in order to get money into your hands. So as you can see on the right side of this diagram, when you incorporate and have your corporation earning business income, it's going to pay layer 1 of tax on those earnings. So the corporation will pay corporate income tax. And then when you pull the money out of your corporation, you will pay layer 2 of tax, which is the personal income tax, when you draw funds out of your corporation. And so you need to understand both personal and corporate tax rates and how they integrate once you incorporate your practice. So let's look at personal tax rates. So these are the personal tax rates in Ontario for this year. So as you can see, individuals pay income tax on a graduated basis. So what that means is as you earn more income, the tax rate that's applied on each additional dollar of income that you earn becomes progressively higher. And you'll see on the bottom of this slide that individuals in Ontario hit the top tax bracket once taxable income exceeds just over $221,000. So if you're a business owner and you make more than $221,000 of business income, every additional dollar of income is taxed at almost 54%. So quite a significant chunk of your earnings at that point is the CRAs. Now, contrast that with corporate income tax rates in Ontario. So this is a summary of the corporate tax rates for Ontario corporations. And here you'll see two parts where personal and corporate tax rates differ. So the first part is corporations generally pay tax at flat rates. So there's no marginal tax brackets like there are with individual taxpayers. The second thing, and very important, is that corporations in Ontario, or corporations in general, pay a significantly lower rate of tax on business income compared to individuals. So most professional corporations are considered Canadian-controlled private corporations, or CCPC for short. So CCPCs, the first $500,000 of its active business income in Canada qualifies for a tax rate of 12.2% in Ontario because of what's called a small business deduction. And business income above $500,000 is taxed at 26.5%. So whether business income in a CCPC is taxed at the very low rate of 12% or the regular rate of 26.5%, both rates are significantly lower than the almost 54% that we saw earlier for individuals that earn over $220,000 of business income. And individuals don't get this small business deduction that corporations get. So if we go to the next slide, so thinking about the diagram earlier of the two layers of tax, now we're going to kind of illustrate this concept by using a numerical example so that we can see how personal and corporate tax rates integrate. So let's say you earn $500,000 of net business income from your practice, and we want to see what the tax impact of earning that amount of income is, depending on whether you earn that income in a corporation or just personally. So you can see in this chart that if you earned $500,000 and didn't need any of it for personal use, you'll see in the third column, just in the middle, you'll have about $206,000 more if you earned that income in a corporation than if you earned it personally. And this, again, is because corporations get a preferential tax rate on business income. Now, if we continue on this analysis and said that you actually needed all of the income to come into your pockets, then you actually end up earning about $3,000 less, or having $3,000 less in your pocket if you first earned that income in a corporation versus personally. So personal and corporate tax rates don't integrate perfectly. If they were perfect, the difference at the very end would be zero. But you can see there's actually a tax cost to earning income in a corporation if you ultimately need all of that money in the same year. So yeah, go ahead.
No, I was going to say, and this is a real key slide that gets referenced very often as we're going through the wealth planning process with clients, because If you don't need the money and you're not incorporated, you're really throwing away big opportunities. And we'll talk further about that, but we'll be coming back to this slide probably in future presentations as well.
Yeah. And thinking about those three questions that I posed earlier, I mean, the results here, the numbers here really speak to I think question one, which is incorporations make sense if you earn more than what you need. So if you do not need all of your earnings on a year-to-year basis, then this extra $206,000 that you have in your corporation represents what I call a tax deferral advantage. And in percentage terms, that tax deferral can be up to 41%. And that leaves you with up to 41% more to either reinvest in your business or start saving, building a fund, a retirement fund. So your corporation really allows you to save more and save faster. And Lauren has shown this slide here, which is illustrating the benefits of being able to take advantage of that deferral benefit. So this example builds on the previous slide, and it says what happens over the course of 20 years if you had that extra $206,000 to invest in your corporation at a rate of 5% rate of return of 5%. So you let that grow over the course of 20 years, and then at the end of 20 years, you say, I'm going to liquidate that investment portfolio, and I'm going to take all the money in cash in my pockets. So you can see at the end of 20 years, the corporate scenario leaves you with more after-tax dollars than if you earn the income personally. And it leaves you with about $97,000 more over the course of 20 years. And that's actual savings by taking advantage of this deferral over a long period of time.
And this is an example of just 1 year, where you have this 1 year
Exactly.
and you're saving you're investing the difference, which is 206,000. So this is 1 year. If you were saving the same amount for multiple years, this obviously gets extrapolated and the savings are significantly larger. This is an example for 1 year.
Yeah.
Okay, are you ready for the next slide?
Yep. So there's definitely a benefit to not taking all of the money out of your corporation on a year-to-year basis, but the previous example is a bit extreme because in reality, you're not going to wait 20 years to pull your money out from your corporation. I assume most people will need some access to it on a regular basis. So what you're really going to be doing is drawing some funds out of your corporation for personal needs on a year-to-year basis. And this is where it becomes important for you to partner with your investment advisor, with Lauren, and with your tax advisors to determine the amounts each year and the form of the payment, because the form of payment can carry different tax implications to both you and your corporation. So on this slide, I've shown some of the common methods of getting money out of your corporation. So for example, if you pay yourself a salary from your earnings, your corporation will get a deduction for the salary. So it won't have to pay corporate tax, but you will have to pay personal tax on the salary paid to you. You'll also have to pay payroll taxes like Canada Pension Plan payment premiums. Now, the other benefit with paying a salary is that you create contribution room to your registered retirement savings plan. And as you're probably aware, if you contribute to your RRSP, it creates a tax deduction. So paying a salary creates that contribution room to be able to make tax deductible contributions to an RRSP. Now, on the other hand, if you instead paid yourself with a dividend, you'll pay personal tax on that dividend, albeit at slightly lower rates than on salary. but dividends do not create RRSP contribution room. So you wouldn't be able to make additional contributions to your RSP, but just by paying out dividends. So there's pros and cons with each method, and what I really want to emphasize here is that benefit with being incorporated is that you now have the flexibility to determine how you pay yourself, and this flexibility allows you to manage your overall tax exposure because you can control when you're going to pay personal tax. So this is a benefit that we often emphasize to professionals who work in practices that where earnings may be volatile from year to year. So, for example, real estate, where commissions can vary significantly from year to year. Using a corporation to earn that income allows you to smooth out your personal income because you control when you pull money out of your corporation. And this is a real benefit that you can take advantage of. So if you are interested in learning more about this specific topic of how to pull money out of your corporation, in what form, tax implications, we do have an education article on shareholder remuneration. So if this is of interest to you, please reach out to Lauren, and he'll be happy to give you a copy of that article that speaks more to this topic.
Okay. Next slide. So yes, this is all part of the goal of the series, is to provide the education, and then the process is really to get an understanding of everybody's unique situation. And so tax laws don't change, but everybody's situation is unique and their goals are unique. But there's not too many platforms in the taxation world that offers this optionality, which is critical to really being as efficient as possible with when you're paying your tax dollars and how much you're paying. So it's really good flexibility.
Okay, so one last thing I'll mention about the topic of pulling money out before we move on is what are called the tax on split income rules, or TOSI for short. You may or may not have heard of it. I showed that timeline of federal tax changes earlier. So one of the important developments in recent years is the expansion of these TOSI rules that I think was 2018 when they became expanded. And the TOSI rules really negatively impact the ability for professionals to split income with family members. So under on the left side of this slide, so under old TOSI, it was common for professionals who were incorporated to add family members, such as spouse, children, as shareholders of that professional corporation, assuming the profession allowed for family members to own non-voting shares. So these family members didn't have to be members of the same profession, didn't have to work in the practice, or even contribute any financial capital for their shareholdings. But the main reason why professionals would add their family members as shareholders was to allow them to pay dividends from their corporation to the family members, so that those dividends would be taxed at the family members' own tax rates. And if the family members pay tax at lower rates because maybe they're not working, or they don't have, or their income levels are low, by being able to pay out dividends and taking advantage of each family member's marginal tax rates, the family as a whole achieved tax savings. And so this was a common income splitting strategy that was used by many professionals. The only roadblock under old TOSI to achieving income splitting was that dividends had to be paid to shareholders who were at least age 18. So if dividends were paid to somebody under the age of 18, then the old TOSI rules would apply to tax those dividends at automatically at the top rate. But as long as they were 18 or over, you could achieve income splitting. Now, when TOSI was expanded back in 2018, what the expanded rules now effectively do is say that unless a specific exclusion applies, all dividends paid to family members by a professional corporation will be taxed at the top rate. So, so there, so you have to first assume that all dividends paid to family members who are not the main professional are going to be taxed at the top rate, and you have to look for a narrow exclusion out of the current TOSI rules, and these exclusions are very complex. Tax professionals are constantly scratching their heads, having to review the rules over and over again for each client scenario. So professional tax advice is really critical if you are in a situation where you have family members as shareholders, and you want to, where you can split some income with them. But I think in most cases, many professionals, because of the current TOSI rules, are now unable to effectively split income with other family members. So we've dealt with many client families that have had structures set up that achieved income splitting under the old TOSI, but now, because of current TOSI, are unable to split income.
Yeah,
So it's a real damper on income splitting.
for a couple of decades almost, when you had professional corporations like medical corporations, one of the ways to save for your child's education in university was simply to save within the corporation and then dividend money at their marginal tax rate when they're 18. And all of a sudden that got completely derailed. So it's it's a good lesson that taxes aren't permanent, and they're likely to get more challenging than lax. But on another note, I'd like to point out that the government hasn't taken away the opportunity to income split for when you're past 65. So a lot of people use their corporations as a way to finance their retirement, and that feature of income splitting with a spouse beyond the age of 65 is still a really valuable feature of the professional corporation. So they've taken a lot away, but they haven't taken everything away. And at this point, it's still good to plan using the income split once they're older.
Yeah, and really, I mean, the TOSI rules are bad, but and they may prevent you from splitting income with your family members for a while. But remember that by incorporating, you're still benefiting from the tax deferral advantage on amounts that you retain in the corporation. And you're still benefiting from the ability to control when income gets paid out to you. So there's still very significant advantages to incorporation from a tax perspective, notwithstanding the TOSI rules. So moving on from talking about getting money out of your corporation, I want to focus on the money that you are retaining in your corporation, because that's really the key here. In order to take advantage of the tax deferral, you need to retain some of your earnings. And let that grow over time. So our government isn't blind to the tax deferral advantage that that incorporated individuals have, and they recognize that this is a significant advantage that people in your position have over those who can't incorporate. So as a result, they've built in a suite of tax rules to try to level the playing field between incorporated individuals and unincorporated individuals. So we'll summarize each of the three measures on this slide.
Sorry, you want to go back there?
No.
Okay.
We can go to the next slide.
Yeah.
Yeah. So the first issue with investing that tax deferral, so that $206,000 that I mentioned earlier, is that when you invest your deferral, and you'll realize that the tax rate that's applied on investment income in a corporation is much higher than the tax rate on business income. So you'll see ordinary investment income in a CCPC is taxed at just over 50% compared to the 12% or 26.5% that it pays on business income. And this 50% rate is much closer to our individual tax rates that we pay on investment income at the top tax bracket. So they charge a higher rate of tax on investment income in a corporation. But what the rules then do is say that a portion of this higher tax is refundable to the corporation once it pays out taxable dividends to you as a shareholder. Because at that point, when you pull money out, the tax deferral ends. So these refundable corporate tax rules are intended to try to integrate personal and corporate tax rates, and are meant to encourage you to distribute your corporation's investment income out over time. And so that way, your corporation gets a refund of some of this extra tax in exchange for you paying personal tax on the dividends that you're receiving from your corporation. So that's issue one. Now, issue two is relatively new, and they are called the passive investment income rules, and they became effective in 2019. So what these rules do is effectively reduce the degree of tax deferral that corporations with business income receive when they're also at the same time accumulating assets that generate passive investment income like portfolio dividends, interest, capital gains, rents. So business income qualifies for a small business deduction on up to $500,000 of business income. And that's why corporations can pay as low as 12% on business income. But what these passive investment income rules do is reduce a corporation's ability to claim the federal small business deduction on a straight line basis once you start earning more than $50,000 of passive investment income. And the calculation works such that your federal small business deduction of $500,000 is completely eliminated once your corporation earns more than $150,000 of passive investment income. So what this rule really does is reduce the total amount of tax deferral that you can receive on business income that you earn. So the maximum tax deferral advantage in Ontario is just over 41%. But if these passive investment income rules come in because at the same time your corporation's generating a significant investment portfolio and generating significant amounts of passive income, the business income that you're earning and retaining in the corporation, the deferral advantage may be reduced from 41% to roughly around 35%. So slightly less tax deferral, but still a lot. You're still potentially able to have 30%, 35% more than what you would have if you earn that same income personally. So these rules aren't the worst thing that can happen from a tax perspective, but certainly if you are in a situation where you're continuing to earn lots of business income, we do want to look for ways to maybe mitigate the extent to which these rules apply. And so this comes down to planning for how you invest that deferral. So using specific investment products or even life insurance as a way to still invest, but do it in a way that maybe reduces the amount of passive income that your corporation is generating on a year-to-year basis.
And sometimes when you just hear the headlines about losing your small business deduction, a lot of people really don't understand the breadth of the situation. They want to avoid this penalty at all costs. But it's important to note, as Sean stated, you're not losing all your deferral. Your deferral is simply going from 41% to 35%, which is still substantial. So again, it's important that you have a team look at your earnings in your specific situation and to see what works best for you and to show you options in order to achieve different goals. And like Sean said, there are investments that don't affect this as directly, and that's something to consider as well. So again, that's what we do is we have to know our stuff first, but then we can't do much without knowing your specific situation. But we're here to certainly help to minimize your tax any way we can. That makes sense. Here you go.
Okay, so let's talk about death. It's a topic we don't want to think about, we don't want to talk about, but from a tax perspective, it's important to think about because when you die, our tax rules deem you to have disposed of your assets for fair market value proceeds, unless those assets are being transferred to a surviving spouse or common law partner. So this deeming provision basically pretends that you've sold all your assets. And so it'll force the recognition of accrued gains and losses on your final tax return. And one of the assets that is subject to this deemed disposition is shares of a professional corporation that you own. And so for incorporated professionals who tie up a significant portion of their wealth in their corporation and have benefited from tax deferral for many years, the tax rules that apply at death can actually, in the absence of proper planning, can create a significant erosion of your wealth because multiple layers of tax can apply as a result of death. And so when we go to the next slide, we'll see this in action. So, so when you pass away as an incorporated professional, there can be potentially 3 layers of tax that you and your estate have to deal with. So layer 1 is when you pass away, you're deemed to have sold your shares of your corporation. And so on your final return, you will have to pay personal income tax on that deemed disposition based on the value of your corporation at that time. Now, if part of settling your estate involves the winding up of your corporation, then there will be layer 2 of tax, where if your corporation has investments in other assets, it will need to sell them before it winds up. And so layer 2 is the corporate income tax that your corporation has to pay in order to liquidate the assets that it owns. Then layer 3 occurs when your corporation needs to take its after-tax funds and then distribute it to your estate. So there's another layer of tax that occurs at the estate level once your corporation's wound up and the net funds are distributed to the estate. And so when we add those 3 layers of tax up, the total tax rate can be over 70% of the value of your corporation. So it's a very nasty amount of tax to have to pay if you don't plan for it properly. So you've gotten the benefit of that tax deferral over all of these years, and then you potentially have to pay over 70% of that to the government. And so with tax deferral comes the need to think about what to do when that tax deferral ends, whether it's because you decide to end it because you need to pull money out, or because of tax rules that force the end of tax deferral, such as on death. So this is where tax planning is especially critical You'll hear of the term post-mortem tax planning. That strictly relates to planning around these issues, and so working with your accountant, working with your financial investment advisors to manage this process and contemplate it is going to be your best bet to reducing this overall tax cost and really leave more to the people who you intend to leave your estate to.
And this is one of the areas where I feel our team really accelerates in terms of the ability to plan. We're in that topic on a regular basis, helping many people, and so we have a lot of wisdom in that space and a lot of expertise, including, well, there's you, tax specialists, and then we have estate planning lawyers and financial planners who come across all sorts of different scenarios where they can pass on their wisdom where they've helped others. So that's why there's a lot of benefits, but if you take a very casual approach to your professional corporation, there certainly are a lot of pitfalls if you're not aware. That's why planning is important.
Of course.
Well, thank you, Sean. You're doing great.
Yeah. So I didn't want to end this presentation on a sour note or a depressing note. So I'll end by discussing one more tax benefit of incorporating. So all of the discussion before now was strictly looking at the tax deferral benefit to incorporating, but beyond tax deferral, your corporation actually provides you the ability to achieve some tax savings when you use your corporation to pay for expenses that are not fully tax deductible. So an easy example of to illustrate this concept is on this slide. So life insurance. So premium payments on life insurance policies are generally not deductible expenses. But life insurance policies can be owned by individuals, and they can also be owned by your professional corporation. Therefore, if you have a policy and to put numbers to it, let's say your policy has annual premiums of $100,000, it will be better to have your corporation own and pay for this policy because it needs to earn less business income to net $100,000 after corporate tax, compared to if you owned and paid for the policy yourself. So your corporation potentially only needs to earn $113,000 or $114,000 to net $100,000 after tax to pay for this premium, versus if you own the policy personally and you're at the top bracket, you need to earn over $215,000 to net $100,000 after personal tax to pay for this premium. And so using a corporation that benefits from lower tax rates reduces the cost of these types of expenses. So you can apply this to other expenses like principal payments on business loans, non-deductible meals and expenses. So having your corporation pay for these expenses is a much smarter and tax efficient use of money. So that's where some actual tax savings can be achieved by using a corporation.
Okay.
Yeah, so that is the end of the main presentation, and so I want to look forward to the rest of the series. So we showed this timeline earlier. I'm putting it here again because we're ending today with the orange dot. So hopefully after today's session, you'll have a better appreciation of the tax benefits that you can realize with the use of your professional corporation. So the tax deferral and some tax savings advantages. And so this lays the foundation for the rest of the webinar. So the next webinar in October will be integrating the concepts from today and the benefits of your corporation but looking beyond just your corporation to the other aspects of your wealth and your financial picture, and looking at building your own personalized wealth plan where we can integrate not just your corporation but everything else, to really have a clear picture of your situation now, what it could look like going forward, and planning issues and opportunities. And then November session will be looking at the looking back at the tax deferral advantage to incorporating, and thinking about how do we take advantage of this tax deferral that you can have, and how to invest that for maximum benefits. So looking at traditional investing versus life insurance planning. So I hope you join the future sessions. I think they all integrate very well. Again, back to that word integration. And with that, that will conclude today's presentation, and we'll open it up to any questions that anybody may have about.
Yeah, we're running. I was going to say we're running a little late, but if you want to,
Okay.
I'll take we'll take one or two questions. But I was just going to say that the nature of this series, it's not a self-help series. It really is, as I mentioned, like the second goal is to introduce the audience to to some of the incredible expertise that you really need and that we offer at Searle Wealth Management in order to achieve the benefits. So it's kind of funny. You think about the days of going to YouTube for financial help. This is not it. This is why you really need to have a team of experts to help you along. And I know we've run over time, and I apologize for that. I don't see any hands up, and I apologize if I miss you, but I think we'll just conclude here, Sean. And we hope everybody will join us. And if you have any specific questions, by all means, send me an email and we'll get you a fulsome answer. And look forward to connecting with everybody who attended today. And thank you very much for taking time out of your schedule to join us. So I was just going to say thank you and good night.
Thanks, everybody.
Take care.